Hey everybody, this is David Skrika, stock chart of the day. So I thought what I would show you today, we're going to go, we just had the inflation report and it came in slightly higher than expected. So I see a lot of articles after when something like that happens, um, saying that, oh, the Fed's now, they're not going to raise rate or so cut rates, but that changed very little. Like actually both the employment report and inflation report have changed very little. It still looks like we're going to see 3 rate cuts this year with a 50-50 possibility of 4. And you have to remember, I've been saying this since last fall. When the market was up to 5 or 6, I thought it was too aggressive. Just like I thought in 2022, the market, one reason I was so bearish in 2022, I didn't think that the market was aggressive enough, you know? I know. So I didn't think the market was aggressive. I thought it was very uh um uh enough. Like people were looking at maybe thinking 200 to 300 basis points, and I figured we had to get to 4 to 5%. We got even higher than I thought, to 5.5, because inflation was really taking off in 2022. So now I think the market got too aggressive, but now I think it's kind of in line more what the Fed is going to do. And I'm going to show you in this video why I think the Fed is going to cut rates, even if I'm still expecting inflation between now and June to continue to maybe trend lower to just slightly below 3%, or 3.2. So that's not a big deal. So first thing I wanted to show you, what's really interesting is this is now the longest period ever that the yield curve has been inverted. The second longest was, you can see, 470 days from 65 to 67, and then 80 to 81, which of course was the kind of bottom of the stock market and top of the interest rate cycle. It was 80 to 80, it was 414 days. And then here at 07, it was 315 days. And what's interesting is that when we cross a higher, that's usually like when we're in a recession. Um, you can see, even though actually it didn't quite do it here in 67, but when it did it in 70, it did it during a recession. And what's kind of interesting, though, it doesn't have to mean have to be a severe recession, because you can see the second longest time period ever. Kind of interesting that it was started the secular bear market, but it wasn't really during some bad recession, and it was a pretty mild bear market in 1966, just like the one we had in 2022. So I think the reason behind some of this like extreme duration in terms of inverted yield curve is that people have been willing to pay up for treasuries, and because they were getting zero for so long, which we'll show you in a second. Actually, I'll show you this right now with the 10-year treasury, the TNX. They were getting 0% for so long. You can see here they're getting 0% here. 5 is actually 0.5%. So under 1% for nearly a full year in 2020, and under 2% really going back 5 to 10 years. Look at the 10-year chart. You can see, we never went really above 3%. And most of that time spent under 250 of the last 10 years. So they were getting no yield for so long. People were like, oh, now I'm getting 4 or 5%, and they're willing to pay up for that. So I think that kind of, even though treasuries fell a lot and yields went up a lot, I think that also kept a buffer under it, because people had just been so used to now almost like decades, and definitely over a decade, of little to no interest return on their interest-bearing instruments and government bonds. So I think that's part of the reason this is continued so long, not just like, oh, we're going into a recession. So I think that's a factor to kind of think about here. So then if we look at this is the interest in the national debt. This is why I still think they're going to cut rates ultimately. So you can see we were at 329 billion in 2013. Now we're at 1,000, or $1 trillion. We hit $1 trillion for over the first time. So we've tripled the interest payments on the national debt. And of course, a lot of that is just simply the amount of debt combined with higher interest rates lead to more interest payments on the debt. And this now, right now, I think the government budget is roughly 6 trillion. I think it's 6.6 trillion. So we're getting to 15, 16% of the budget is going to interest payments right now, which is, getting into the danger zone. I'd say when you get into 30% or 25 to 30%, you're in real danger, because a quarter of your budget is just going to interest on the debt. Now, this isn't all purely go to interest, because the QE, this is the kind of scam that QE set up, that I think 5 or 6 trillion of the debt is owned via QE. So that's roughly, let's say 15%. So that means 150 billion of this just goes right back to the treasury. So really only 850 of this is actually being paid out to investors and outside the government. But that just tells you how they have to monetize the debt. That ultimately, let's say this interest payment goes to 2 or 3 trillion, it means that they essentially have to own 50 or 60% of the debt. So to keep that interest payment from just eating in to their own deficit. And then at some point, I think what happens is you get a de facto default. They'd say, okay, all the debt that the Fed owns is gone, because who really cares? Or it's whatever. It's now a 100-year bond payable 0% interest, because really it's the government that owns it anyhow. So I think that's kind of like where we ultimately go. So ultimately where we're going is to monetize the debt. So this whole thing where like the Fed has to keep rates higher for longer to beat inflation. Sorry, people. Inflation is here and it's here to stay, because they're going to have to monetize this debt at some point. Especially remember, demographically, we're now heading into the baby boomers retiring. So Social Security, Medicaid, Medicare, which we're going to show you right now are the biggest part of the deficit, are going to just increase. So you can see here that you see the interest payment being 4.3 trillion. You see the U.S. national debt at 3, or a total U.S. interest paid, sorry, is 4.3 trillion at 34 trillion. And if we go look at the debt, there's a debt by foreigners at 8 trillion. There's the trade deficit, all these other things here, et cetera, et cetera. We can see that the issue here. So you can see the federal spending here is 6.6 trillion. Like I said, it was actually right on and what I said. So you can see this is the problem. You can see Social Security, Medicaid, Medicare liabilities, 26 trillion and 40 trillion. So this is of course, this is always the problem right now, et cetera, et cetera. So at some point, this is going to be the largest portion of the debt. So it's very simple math. So right now, like I said, we're paying $1 trillion. Debt is 34 trillion. You do the quick math on that, $1 trillion divided by 34 trillion, that's roughly 3%. So roughly we're paying 3% interest on the debt. Now, the one reason it went down in 2013 like that is, we remember, again, the interest on the debt was essentially going to zero in 2013 as the Federal Reserve, cut rates, had the zero rate policy. And remember, this is the 10-year bond. If we go look at the IRX, which is the 3-month T-bill, which is closer to like the 2-year bond, you can see this was almost zero for years and years and years. Other than this little spike to 2%, if we actually go back 17 years to the financial crisis, you're going to see this was zero here. And a lot, during this time frame, the 1-2-year bond was at like 1-2%. So the interest payment plummeted because most of the government debt is issued in these kind of 1, 2, 3-year bonds, these short-term duration bonds. So the quick math, what I wanted to show you is, now that we've gone up to an average about 3%, we're at 5%. Well, let's say all of the debt that the U.S. owned was rolled over at 5%, or an average of 5%. Then we're at 1.7 trillion. So that adds another 700 billion. But of course, that debt's going to go up too. So say it goes to 40 trillion and it's 5%. Then you're talking 2 trillion of interest. And I showed you the budget at 6.6 trillion here. Well, that means we go from $1 billion to 2 trillion, just like that. And of course, that increased interest expenditure, that 1 to say 2 trillion, that goes right on it. So the deficit goes from, it's estimated to be 1.8 trillion this year. The deficit goes to nearly 2.8 trillion. So, it's just unbelievable. And actually, this Charles Bialo, he had another excellent chart recently. This guy's got a great account, by the way. I highly recommend it. This is the deficit right here. And, this is because I hate social media and I want to get off it. But then I see like there are great like resources like this on it. So you can see we're at 1.8 trillion here. And I think it's going to be closer to 2 trillion this year. And you can see the excess spending we had during COVID went to 4 trillion. And notice if you kind of do the trend line here, you can see that the smaller deficits at the top of the economic cycles keep getting larger and larger. We had a surplus in the late 90s, and then we had a $145 billion deficit, right before the financial crisis at the top of the cycle. And then, in the mid 2015 or so, 14, it was 400 billion. And then it went to 900 billion in this last cycle. So we'll probably have another $3 trillion deficit. And another interesting part of that is, again, like $3 trillion, again, say that. So that just, and again, if those average yields are higher. So that's part of the reason the Federal Reserve, in my opinion, has to cut interest rates this year a little bit. Doesn't matter that if inflation keeps up around 3%. I think they might even at some point to say the 3% is the new 2%. Remember they had those stupid sayings for years that, 40 is the new 30, for getting old. And I can tell you, I'm 46 and 40 is not the new 30. My body was a lot worse at 40 than it was at 30. But anyhow, I think that we're going to continue to see this surplus deficit in billions of dollars in interest continue, and they're going to have to cut just to get that down. Because again, let's say again the average yield on the debt goes from 5% to 4%, and let's say for argument's sake that the debt is 40 trillion. Well, that means it goes from 2 trillion in interest payments to 1.6 trillion. So at least you get 400 billion less. I think it doesn't matter. I think ultimately it's too big. Then remember, the next recession, the economy will shrink and the deficit will expand because government, it always expands because there's less revenues coming in because less people are working, less people are paying taxes, and there's more outlays. There's more people collecting unemployment and benefits. That's what happens in recessions. That's why you can see here. After the dot-com bust, we had a 400 billion deficit. The early 90s, you can see it was over 300 billion. It went to 1.4 trillion in the financial crisis. And then we went to a huge 4 trillion as the economy came to a halt for a few months during COVID. And they did all these one-time payments, stimulus payments, et cetera, et cetera. So we're going to see this probably, again, go to the 3 trillion range. And here's the issue, though. I'm talking about them trying to keep interest low because the government can go insolvent. There's an excellent bunch of studies done by the famous fund manager Ray Dalio, and he says you enter a debt crisis when you hit over 130% of GDP. Historically, that's when countries have started to have problems, and their economies have started to struggle. It happened to British after the World War I when they went over 150% of GDP, and it stood there for nearly 20 years. And the British economy really stagnated in the 20s while the U.S. boomed. And so that debt load really affected them. And we've seen it all throughout the years. And the British got off easy because most countries start going bankrupt at that point. We saw that with Greece when they went over 150% of GDP. So, most countries after over 130 just kind of go into this huge debt spiral. The British, because they were the reserve currency, just stagnated. I guess that's the best case scenario for the States. But here's the difference between the British then and the States now. In the 20s and 30s, the British were very fiscally responsible. That debt to GDP did not really move. It just went sideways for 20 years. It was like they became bankrupt essentially because of the expenses of World War I and the expansion of the empire, which kind of ended after the First World War. They still had the huge empire, but they weren't expanding it anymore. So they kind of flatlined. Well, of course, the US, as we saw now, is now like the new normal is not 100, 200, $300 billion deficits. It's $1, $2, $3 trillion deficits. So we're really seeing this issue now. And if we take the quick math that the deficit could be 2 trillion this year, and the GDP is 27 trillion, that's about 7 to 8% of GDP. Boom, we get that 130% next year. So I really believe that interest on the debt, which is nearly that $1 trillion now, and see when it says net, again, that kind of gets into the point I'm talking about where the total interest is $1 trillion. The net means minus some of those, that QEs where some of that interest is going back right to the Treasury. But we're still at nearly 8 trillion. We're still at, 12% of the federal budget. Essentially, I would say a doubling of that interest on the debt is going to really hurt us. And the only way to get out of it is to monetize things. So there's no easy way out here. You go bankrupt, which essentially means, the currency would collapse and you default on debts and the U.S. wouldn't be able to ever borrow again. Or or you could have a deflationary spiral in that regard because the government, or if you have austerity, because the government has to cut back spending like crazy, fire people, stop paying out outlays to balance the budget, or you print your way out of it. And the most likely scenario is not a default, is to print your way out of it. So this is why, I think this is why we're seeing a breakout in gold and some of these other inflationary hedges, because I think, the market, they say, is forward looking. It's starting to, I would say, anticipate this. Now, some people might say, "Oh, Dave, this is why crypto is going out too." But I've said this. I think the issue with the Bitcoin breakout is you got the ETF. Bitcoin really just tracks the Nasdaq, etc. So what's interesting too, I've shown you like in my last video, my Bahamas video. Oh, I'm going to end off on my crazy story for the Bahamas, just to end off what's on my mind. But the but I've showed you that Bitcoin is kind of just reflective of the Nasdaq, and I showed you the stock market cap to GDP. I think that this could very well be a long-term hurrah for the stock market, like 2000, like 1929, like 1966, because we're at these extreme valuations and also heading into this debt. Now, the stock market, maybe after an initial plunge, may go to all-time highs, but it could be because you're in an inflationary spiral and adjusted for, this has happened in Argentina, this has happened in Turkey and the local stock market there. When you have these hyperinflations, stocks are also a hedge. Just going to show you the Argentinian stock market to see what I'm talking about now. Look at it, it's over 1 million. But you can see inflation peaked like a month or two in Argentina. So it's not even really falling again because now inflation is starting to peak there. But if we go look at like a really long-term chart, we know that Argentina is not doing well. Almost 50% of the population lives in poverty. But look at the MERV went from 6,000 to 1.2 million. And it's like, it's because this was stocks are an inflation hedge. So that's like a longer term. That's a good scenario for your portfolio. Is obviously I prefer to be in precious metals and gold, which are the ultimate hedge, but equities, your home value is going to go up too. Remember, that's another way they can get rid of all this household debt. If I'm not saying we're going into Weimar Republic hyperinflation here, but if all of a sudden the average wage for somebody is $50 an hour, or your $400,000 mortgage is not as hard to pay, and you can get rid of all this household debt just by inflating it away. It will kill new housing because interest rates will be high. People won't be, it will be too expensive to even build a house, et cetera, et cetera. But like the actual people who are in their houses, it will really help them. So I just wanted to show you this. This is the issue. This is why the Fed has to cut interest rates right now. This is why ultimately they'll have to monetize the debt because that interest payment is going to get too high. Now, that monetization of the debt is the last ditch scenario. So I see them trying to cut this right now. And also, if, say, Trump were to win, I think that Trump is going to find someone much more dovish than Powell. He's going to want to get those rates down to 2 to 3%. And that could very well happen because even if we're in a secular uptrend for bond yields, we could still go to 2 to 3% very easily before the next kind of wave higher. And I think Trump would want cheaper money to juice an economic boom because he's the big the big real estate mogul, et cetera, et cetera. Look at America's doing great type guy, right? So that's also something to watch. But again, I just wanted to show you why I think the Fed has to cut interest rates, the issue we're starting to see with interest on the debt, and also why we're in such a long inversion, because we had these low interest rates for so long. I think people have been willing to pay up for bonds, even though they're below the short-term yields, because they're like, when bonds went to 5% last October, remember, they were yielding 0.5% just 3 years earlier in 2020. So people are like, wow, now I can get 5%. And anyone who bought then, by the way, the TLT, which is, the long-term bond ETF, is also up 12 or 13% in price. So you're getting the 5% coupon, plus you've made 12%. So that means for at least now, of course, you're not a whole full year in, you're only roughly 5-6 months in, but you could potentially make 17% on your bond investment if you had bought at the bottom. So, but that's another story. So I just wanted to show you this. This is the issues we're going to have going forward. Like, I have been worried about this since I was a teenager, believe it or not. I know it's a weird thing to worry about as a 16-year-old kid in 1993 when I read Bankruptcy 1995 by Harry J. Figge, but it took 30 years. I never thought it'd be, by the time I was almost a middle-aged man at 50, that it would have happened again, but it has, or I wouldn't have happened by now, but it looks like it's finally going to start. And again, if the Ray Dalio studies are right, I think we'll start to see some problems in 2025 and 2026 as we get over that 130% of GDP. Okay, thank you very much. This was a longer one, but I think this one was important. Oh, and my story from the Bahamas conference. I have to tell this. So I talked about doing the conference at Atlantis. This is one of the craziest stories and one of the things that ever happened to me. It was only a split second, but it's probably the most memorable aspect I had of this conference. So at the time, I had a Ford Mustang, and I don't know how well all of you know Nassau, but I lived out in Cable Beach, which is on the west side of the island. And we did a little get together at a little cafe I loved, a little Italian place called Cafe Milano. Unfortunately, it's closed now. I just learned that Cafe Matisse was closed in my last video. Someone wrote a comment. I was like devastated. That's like my favorite restaurant in the Bahamas. But anyway, I digress. So we go, I'm driving everyone back because this Cafe Milano is also in Cable Beach. So everyone's staying in Paradise Island on Atlantis, which is about a half an hour drive. A lot of people don't have cabs, they don't have rides. So, Bahamas is kind of more lax in rules. I'm like, everyone get in the back. I got like 7 people. It's a convertible in the back of the Mustang's 6 inches off the ground. I'm driving like 20 miles per hour because, Mustangs are low lying to begin with. So any speed bump or whatever, I'm going to hammer the bottom of the car. And then there's this tunnel you go under to get to the entrance at Atlantis. So we're going through the tunnel and we're just exiting the tunnel. It's a small tunnel. And as we're exiting the tunnel, this guy in a fancy car, it was like a Maserati or Lamborghini or Porsche or something. I still remember it. He goes speeding past us. I'm talking like, in this little tunnel, you're supposed to go 20 miles per hour. He's going like 100 miles per hour. I'm like, whoa. And then literally 5 to 10 seconds after he passes us, all I hear is boom, 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 boom. The guy is smashing off the walls. He's probably, this is rich people partying. He's probably hiked on coke and drunk. And I just look back at everyone in the car like, oh my God, if we had just been out of this thing 10 or 20 seconds earlier, oh my God, like we could all be dead. So anyhow, that's the kind of crazy story. And it's kind of, I still, once in a while, I still think about that story because it's just weird how life is that way. Like, I don't know if it's luck of the draw or the whatnot, but yeah, again, like 10, 20 seconds earlier, that guy wouldn't have just been crashing off the walls. He would have potentially been crashing into me. And, I had 6 people in the back of my car. So I thought I'd leave it at that. And I hope everybody's doing well. This was a little bit of a longer one. I think this was a good one though. I had some fun doing this one. And, this is the kind of thing. Hey, where else can you get information like this for the best price, which is free? Take care, everyone. Bye.